Right, listen up. Welcome to The Explainer. Today we're tackling the ultimate ACCA management accounting heavyweight showdown. Literally, this is the battle that trips up thousands of students every single sitting. We're putting absorption costing right into the ring against marginal costing. And look, this isn't just about moving some numbers around on a spreadsheet. No, this is about understanding how the fundamental rules of accounting can completely, and I mean completely, change the profit a business actually reports. If you're going to conquer this exam, you absolutely need to master this showdown. So focus up, grab your notebooks, and let's get to work.
I want you to really think about this for a second. Why does making more product magically increase your profit? Seriously, even if you haven't sold a single extra unit. Imagine a factory just running its machines day and night, right? Pumping goods into a warehouse where they just sit there, collecting dust. How on earth can the income statement suddenly show a higher profit? It sounds like a total illusion. It sounds like financial manipulation. But guess what? It is a very real, strict mathematical consequence of the costing rules you are required to know. Before we break down the mechanics of it, you need to recognize that this profit illusion is exactly what the examiner is going to test you on. We're going to expose exactly how this happens. Okay, let's dive straight into it. We're looking at two completely different philosophies for valuing the goods you produce: absorption costing and marginal costing. And make no mistake, their entire battle, the sole reason they spit out different profit figures, comes down to one single crucial factor: how they value inventory. They look at the exact same factory, the exact same workers, the exact same sales, and treat them completely differently. One philosophy acts like a factory just dumping every single part and cost directly into a box to keep it, while the other takes a sharp pair of scissors and just cuts certain costs right out of the supply line entirely.
Let's start with the reigning champion of financial accounting, absorption costing. Here is the golden rule, and I need you to memorize this exact one-line summary. Lock it into your brain right now. All production costs go to inventory. Under absorption costing, every single cost incurred in the factory to make that product is literally absorbed into the value of the inventory. It doesn't matter if the cost goes up or down based on how much you produce, or if it stays exactly the same regardless of output. If it's a production cost, it is going straight into the inventory valuation. Non-negotiable.
Now, what's really fascinating is how we actually break down those costs. Think of an absorption costing inventory valuation like a physical box holding four distinct things. You've got your direct materials, the raw wood or the metal. You've got your direct labor. Think of the worker's hard hat. You've got your variable production overhead, like the electricity and the light bulbs running the machines. But then there's a fourth item, a heavy, chained-up safe sitting right there in the middle of the box. That safe is your fixed production overhead. We're talking the factory rent, the supervisor's salary. Under absorption costing, a portion of that fixed factory rent is literally locked inside the value of the product sitting on the warehouse shelf. It's completely trapped in inventory.
So how exactly do we force a flat, fixed cost, like a £10,000 factory rent, into individual units of inventory? Well, we use the fixed overhead absorption rate, or the OAR. It's a simple two-step process. Step 1, identify your budgeted fixed production overhead. Step 2, divide it by your budgeted activity level, which is usually units produced or labor hours. That gives you a rate per unit. So if your rent is 10 grand and you plan to make 10,000 units, your OAR is £1 per unit. Every time you build a unit, £1 of fixed overhead gets absorbed right into it. But listen to me carefully here, because this is entirely based on budgeted figures. This creates a massive risk of over or under absorption in your P&L if your actual overhead or actual activity differs from that budget.
Right, abruptly shift your attention over to the challenger, marginal costing. Here is your ultimate one-line summary trigger for the exam. Marginal costing. Variable costs only, fixed overhead expensed immediately. This method basically takes one look at absorption costing and says, absolutely not. Marginal costing strongly argues that fixed costs are costs of the period, not costs of the product. Your rent is a cost of just being in business this month, regardless of whether you make 1 unit or 1 million units. Therefore, only the variable costs get attached to the inventory.
Now, compare marginal inventory in your head to what we just looked at. Direct materials? Yep, the wood is there. Direct labor? Yes, the hard hat is there. Variable production overhead? Yes. Now what is missing? The fixed overhead. That heavy, chained-up safe is entirely stripped out of this list. It is not going in the warehouse box. Instead, watch what happens. The absolute second a fixed production overhead is incurred, it takes flight, completely bypasses the balance sheet, and is essentially burned straight away in a flaming trash can. It gets sent immediately to the profit and loss account as an expense for that exact period.
This brilliantly illustrates the entire core of the topic. This heavy anvil of fixed overheads, that is the sole battleground.
With absorption costing, it forces that heavy anvil to just sit on the balance sheet shelf as an asset, suspended right there until the unit is finally sold. But with marginal costing, it drops that anvil straight into the P&L fire immediately. This timing difference, literally just when the fixed cost actually hits the income statement, is the absolute only reason these two methods will ever report a different profit figure.
So the absolutely crucial point here is how we calculate that exact profit difference. I want you to forcefully instruct yourself right now to write this formula down. Profit difference equals the change in inventory level multiplied by the fixed OAR per unit. Boom! This is the mathematical proof of the profit gap. You do not need to draft two massive, highly complex income statements from scratch in the exam just to find the difference in profit. You just need to know how many units inventory went up or down by and multiply that by the fixed overhead absorption rate per unit. That is your ultimate shortcut. Now let's build this into an ironclad set of rules for your exam. I want you to walk through these scenarios with me systematically. Scenario 1. Inventory increases. This means you produced more than you sold. What happens? Absorption profit is strictly greater than marginal profit. Why? Because absorption costing traps those fixed overheads inside the unsold inventory over on the balance sheet, keeping those costs completely off the P&L, which artificially inflates the profit. Scenario 2. Inventory decreases. You sold more than you produced, meaning you dipped into last year's stock. Now, absorption profit is less than marginal profit, because last year's trapped fixed overheads are finally released into this year's P&L. Scenario 3. Inventory stays exactly the same. Production equals sales. In this case, the profit is exactly equal under both methods.
Stop whatever you're doing right now and listen to me very closely. This is a massive exam trap. The examiner is setting a literal bear trap for you right here, trying to catch you out by just wording the scenario a little differently. They aren't always going to nicely say, inventory increased. No, they'll say, production volume exceeded sales volume for the period. You must immediately translate that in your head. Production greater than sales means inventory is up. And if inventory is up, absorption profit is higher. Do not step into this trap. It is a classic, highly tested trick. Lock this relationship down right now.
We're basically at the finish line here, so lock these two metaphors into your mind right now for some last-minute rote memorization. Absorption costing is a sponge. It soaks up all production costs into inventory, even the really heavy fixed ones. Marginal costing is a colander. It catches the variable costs, sure, but it lets the heavy fixed overhead drop straight through. If you understand these two metaphors, you understand exactly how the inventory is valued. If you understand how the inventory is valued, you completely understand how fixed overheads are treated. And if you understand that, you have total control over the profit difference. Which brings us to our final challenge for today. Will you fall for the profit illusion on exam day? Seriously, when the examiner throws a sneaky scenario at you where production outpaces sales and the profit magically spikes, are you going to be confused, or will you know exactly why? Apply the matrix we just went over. Remember the strict treatment of fixed overheads. Understand the raw mechanics. If you apply this knowledge, you will absolutely dominate this topic. Now, get to the practice platform. Apply those formulas and execute. You've got this.